This is part 2 of our Chapter 9 video lecture. Back in part 1, we had learned about reporting rental operations here on Schedule E, assuming that the property was rented or available for rent throughout the whole year, and the owner, the landlord here, the taxpayer, did not use it for personal use at all throughout the whole year. Now, if the property is owned by, let's say, a, a partnership or a corporation, then probably you have to report the rental operations on a partnership return or a corporate return that we'll learn how to prepare later on in this semester. There are exceptions to that. Let's say that the partners, the only partners in the partnership, are a married couple. And what you can do is check off this box for that property. And instead of preparing a partnership return, you can just report the whole thing on this Schedule E, assuming that again, that married filing joint couple are the only owners and they materially participate in the management of the property. Just like typical landlords take care of everything, or they have the right or the power to hire people to take care of the property for them. Okay, so that's what they call a qualified joint venture. Now, if you have taxpayers that are not married and they own the property through what they call tenants in common, not really through, again, a partnership or a corporation. Maybe an example would be some siblings who inherited a rental property from their parents and they just own it as tenants in common. What you can do is report their share of the rental property on their Schedule E. So if you're one of the siblings and you own 50% of the property and your brother or sister owns the other half, you can report just your half of the property's income and the deductions on your Schedule E. Some software may require you, let's say, to enter the whole 100% and then give them a percentage of the amount that's going to be reported on your return. But again, if the property is owned, the title is owned by a partnership or a corporation, or we talked about entities called a limited liability company, which is becoming more and more popular for rental property, then you probably need to prepare a partnership or corporate return. And if the income or loss is being passed through to the owners, to the partners of a partnership, or shareholders of a S corporation, a limited liability company would probably prepare a partnership or corporate return. Then we've seen in the back of the Schedule E where the partner of a partnership or a shareholder of S corporation would have to report their share of the income. We'll talk about this passive income or loss in the next video. So let's say that we're going to convert some personal property, personal use property, a residence, into a rental property during the year. So let's use a scratch paper here. So here's our timeline. Here's our year. And at the beginning of the year from the previous year, the property was a personal residence. But then during the year, we converted into a rental property. So this is what we call a straight cutoff. You start taking into account the rental operations just from the point you start renting it out or it's available for rent. It could be vacant as long as you're trying to get a tenant. At that point, you're probably able to start deducting rental expenses. Anything prior to that, you cannot claim any rental expenses. Maybe you can claim the home mortgage interest or the real estate taxes as itemized deductions on your Schedule A. But from this straight cutoff here, when you convert it to rental, that's when you can start taking rental expenses and reporting the rental income. Of course, one of the big rental expenses is depreciation. So the amount of costs you're going to take into account to depreciate is either going to be the original costs allocated to the improvements to the structure. Remember, we don't depreciate land, but you're going to compare that cost, the depreciable costs, to the fair market value at the time you make this conversion. And of these two amounts, you're going to use the lower of the two to calculate your depreciation. Um, of course, most times we hope, and especially here in Hawaii, real property increases in value. So the cost is probably the one that's going to be lower. And I forgot to mention in the previous video, when you calculate out depreciation, like we saw it back in chapter 8, we typically use the maker's depreciation. And for real estate, the convention was the so-called mid-month. Remember, we start depreciation from the middle of the month. We put the property into service. And in the case of residential property, we use a 27 and a half year life. And in the case of non-residential, we use a 39-year life. And both lives use the straight line method. You can either use the formula discussed in our textbook, or the preferred way is to use the rates in the depreciation schedule. I believe I have linked in our Laulima chapter resources folder that gives you the annual depreciation rate for each year you own the property. Now, how about if you convert the rental to personal during the year? Well, you just keep track of, again, the expenses during the rental period and deduct that. And then once it turns personal, you only can claim the mortgage interest and real estate taxes as itemized deductions on your Schedule A. I wouldn't just assume that you take a proportionate part of the year. Like, let's say this is the middle of the year. I wouldn't just take half of the cost, yeah, and treat it as rental versus personal. You should actually keep track of the time it's rental and take the actual cost during that period as your deduction. How about if you switch back and forth between personal and rental throughout the whole year? Well, that gets into the topic that's kind of complex here in chapter 9 called a vacation home, where our taxpayer owner has a main residence. But if you remember back in chapter 5, a taxpayer can take a home mortgage interest deduction on two residences, subject to that $750,000 loan limit, or it can be grandfathered in at a higher limit prior to 2018. Well, if you have this mix of personal and rental throughout the year, then there's going to be other rules that apply to limit the amount you get to deduct. So our textbook has some discussion of the rules, but I want to kind of to make it more visual. So there's this handout here in our chapter 9 Laulima resources folder called Rental Real Estate and Vacation Home Rules. And it's a spectrum of different rules based upon if you're looking at personal use. So here's where we use the residence 100%, no rental, just like we did back in chapter 5 for itemized deduction. And the other extreme is what we've covered so far, 100% rental use of the property, no personal use. So going over these two extremes, again, in the case of personal use of the property, we're not going to have any rental income, so there's nothing to report there. And of course, we're not going to have any related rental expenses to deduct. But you still get to deduct your home mortgage interest and real property taxes on your Schedule A. Again, remember now there's limitations to the interest deduction based upon the dollar amount of your loan balance. And in the case of taxes being deducted as itemized deductions, there's a flat $10,000 limit for the total tax deduction on Schedule A. On the other extreme, if you rent your property out or have it available for rent, no personal use throughout the whole year, you gotta include all of that rental income as taxable. But then you get to deduct all of the related rental expenses we've learned so far here in Chapter 9. Now, if you have a loss, we'll talk about this passive loss rules that may limit the amount you get to deduct in the next video. Now, the middle three talks about um, where you have this 15-day rule, 15-day rule, and it's either less than 15 or greater than or equal to 15 days. Now, if you rent your property for less than 15 days throughout the whole year, the good news is that you don't have to report any of that rental income. Of course, you're not going to have any deductible rental expenses, but you still get to deduct all of your itemized deductions, again, subject to those itemized deductions limitations. So maybe let's say there's some big event in your town that you want to avoid the traffic and congestion. So you want to leave, but you still want to make some money. So you're going to rent out your home for, let's say, 2 weeks, right? It's less than 15 days. So you go on Airbnb and you put it up for offer, and the rent you collect for those 14 days is going to be tax free. One of the few places the government gives you tax free income. Now, once you hit 15 days or more of rental use during the year, one of these two middle columns is going to apply. And if you see the conjunction here, and, yeah, and there's another test you have to look at. It's whether your taxpayer's use of that property is greater than the larger of these two amounts or less than or equal to the larger of these same two amounts again, yeah? The thing here is there's more personal use here than personal use over here. Again, both meet the more than 15 or 15-day tests of rental usage here, yeah? The difference is that there's a big personal use here and less personal use here. In either case, you have to include the rental income no matter what. Remember, the only time you get to exclude rental income is when you rent it for less than 15 days or no rent at all, yeah? But then the difference between these two situations is that if you calculate out a loss here, the loss is not deductible. If you calculate out a loss over here, the loss is deductible. But in both cases, you gotta allocate the expenses between the personal use and the rental use. The personal use and the rental use. That's why back here on Schedule E, they asked for the amount of days that it was rented, not just available for rent, but there was a tenant in that property during the year. How many days? And how many days the owner had used the property for personal staying, personal use. You don't count any days here in these two columns when it was vacant. So what you're going to do is you're going to add up these two columns and get a total usage for that property during the year. And you take the day's rental and divide it by the total to get a fraction of the amount of expenses that you're gonna claim. Like maybe the mortgage interest, you take that fraction and put it over here, yeah? Or utilities and that fraction, you put it here. Now, if you can identify anything just specifically for rental, especially like advertising, you wouldn't advertise for your own personal use, right? So you can deduct the whole thing. But again, when you total up the expenses and you generate a loss, here in this column, we have lots of personal use, the loss is not deductible. And here in this column where there's less personal use, the loss is deductible. So it looks like there's 1, 2, 3, 4, 5 different situations. And these two are the more complex ones here, yeah? So the best way to analyze this is to take a look at an example. So here in our textbook, Look like on page 10 of chapter 9, they have this example for the ratings. And they give you two different properties, property A and property B. In the case of property A, this West Street, it's 100% rental, no personal use. But this property B, Vanderbilt, looks like it's total 120. So three fourths, so 75% is rental and 30% is personal. So this is 100% numbers here, and this is 75% numbers. Of course, this would be the 100% rental income no matter what for these two, yeah? But down here, mostly it should be 75% of the actual expenses. Now notice the rental income equals the rental total expenses, ending up with no loss because that's the rule, right? You cannot have a rental loss if you meet this test here. So if you remember the numbers, 90 days rented is greater than or equal to 15 days. So you meet this first test easily. It's the second test. The 30 days of personal use is larger than either 14 or 10% of 90, which is 9 days. And of the 14 and the 9, you take the larger, which is 9. And then the personal days of 30 is greater than 9, right? So you meet this test. You still have to allocate the rental expenses between personal and rental. Remember, that's probably 75% for rental. But you cannot deduct a loss. So now the order you're going to claim the expenses, if I can get back to my example, is here for this property. The expenses you're going to deduct first is the mortgage interest and the real estate taxes. Expenses that you can deduct anyway, right, as itemized deductions. Then you start deducting the other cash expenses. But then, again, you cannot have more than the 15,000 income in this situation. So if you still have a profit, the last expense you're going to deduct is depreciation. Again, still probably based upon that maker's method. According to the facts here, if you calculate out the depreciation, the total would be 8,045. But again, that would generate a loss. So you just use this amount here. The informal term accountants use is to plug. We plug in a number here, so the total expenses is going to match the revenue. So our amount down here that is a net zero income, net income or loss. Yeah. Ultimately, all we're reporting is just the net income from one of that other property here. Okay, so that's the vacation home rules. Again, take a look at this handout in our La Lima resources folder, and I think it kind of simplifies the rules given to us in the textbook. Go ahead and take a look at the next video where we talk about passive loss limitations.